Have you ever found yourself staring at your screen, watching the market move and feeling like you just have to trade? You know the feeling. Your fingers itch to click, to make that trade, to get in on the action. Maybe you've even convinced yourself that the next one is the perfect setup, the one that's going to turn everything around. But here's the truth. The more you trade, the more you lose. It sounds counterintuitive, doesn't it? After all, we're taught that more action means more opportunity, right? More trades should give you a better shot at profits, right? The reality, however, is far more brutal. The more you trade, the more you expose yourself to emotional turmoil, the more you let your fear and greed dictate your decisions, and the more you lose control over your trading account and, eventually, your confidence. Overtrading isn't just a bad habit, it's a self-destructive cycle that, if left unchecked, will bleed your account dry. Now, let's pause for a second. You're not alone in this. Most traders, especially beginners, think they need to trade as much as possible to make money. They believe that by increasing their trade frequency, they increase their chances of success. But here's the thing. This is exactly what professional traders avoid. They understand that success doesn't come from making more trades. It comes from making better trades. And often, that means waiting, being patient, and resisting the urge to act impulsively. So why does overtrading feel so irresistible? Why is it that the more you trade, the more you lose? It all boils down to one thing: emotional impulses. In trading, emotions can be your worst enemy. They cloud your judgment, distort your perspective, and lead you to make decisions that are not based on logic or strategy, but on the need to feel in control or to recover losses. Let's break it down. When you trade too frequently, you're chasing after quick wins. You're looking for that instant gratification. I'll take this trade, and if it hits, I'll be up $50 or $100, maybe even more. But here's the problem. Trading like this turns into a gamble. You're not sticking to your plan anymore. You're trading based on impulses, on emotions, and that is exactly how you lose control. And here's where it gets interesting. This impulse-driven trading isn't just bad for your account balance, it's bad for your psychology. Every time you take a trade based on emotion, you're giving away a piece of your mental strength. This is why many traders feel mentally drained after a long trading day. They've made so many trades, chased so many setups, that they've exhausted their emotional resources. And at the end of it, they're left with nothing but losses, frustration, and the sinking feeling that trading might not be for them. But here's the kicker. Trading more doesn't mean you'll make more. It's quite the opposite. The more you trade, the more likely you are to make mistakes, to take trades that don't fit your strategy, to take unnecessary risks, and to react impulsively. The more trades you make, the more likely you are to fall into a psychological spiral where every loss feels like a personal defeat, and every win feels like a tiny victory that barely makes up for the losses. This brings us to a critical point. Overtrading destroys your edge. Every professional trader has one thing in common. They understand their edge, they trust it, and they stick to it. An edge is the advantage you have over the market, the reason why you win more than you lose. It's the strategy you've honed, the one that works consistently over time. But when you overtrade, you abandon your edge. You start chasing anything that looks like a setup, even if it's not part of your plan. You stop trading with an edge and start gambling with your account. This is why the best traders don't focus on the number of trades they make. Instead, they focus on the quality of each trade. They know that by waiting for the right setups, they increase their chances of success. They're patient, disciplined, and calculated. Overtrading doesn't fit into their mindset because they know that in order to be successful, they have to wait for the market to offer them an opportunity that aligns with their strategy. And this brings us to a fundamental concept in trading: patience. Patience isn't just about sitting and waiting. It's about knowing when not to trade. It's about understanding that sometimes the best decision you can make is to stay on the sidelines. Professional traders know this, and they've mastered the art of waiting. They understand that the market doesn't always provide an opportunity to trade, and that's okay. They don't feel the pressure to make a trade just because the market is open. They wait for the perfect setup, and they only pull the trigger when everything aligns. The irony here is that by trading less, you actually increase your chances of success. This doesn't mean you should never trade or that you should wait for the perfect setup every single time. But it does mean that you should be selective. The market isn't going anywhere. There will always be another trade, another opportunity. But the key is to wait for the setups that have the highest probability of success. And that takes patience, discipline, and most importantly, control over your emotions. When you first start trading, you're often swept up in the excitement of it all. Every market movement feels like an opportunity, and every tick up or down seems like the perfect chance to jump in. It's easy to fall into the trap of overtrading when your emotions are running high, and here's why. The psychological drivers behind overtrading are more powerful than most traders realize. One of the most common emotions that fuels overtrading is greed. After all, if you've made a profit on one trade, why not try to make more? It's a natural instinct to want to repeat what worked. But here's where the problem lies. Trading isn't about chasing profits. It's about consistently following your strategy and waiting for the right setup. Greed clouds your judgment, pushing you to trade more than necessary. You start ignoring your strategy, taking trades that you wouldn't normally take, and your edge starts to slip away. You're no longer trading based on logic, you're trading based on the desire to win more and more, faster. But greed isn't the only emotion that makes you trade more than you should. Fear is another massive driver. Fear of missing out, also known as FOMO, is something every trader experiences. You see the market moving, and you worry that if you don't get in right now, you'll miss out on a big move. It's the fear that if you don't act immediately, you'll be left behind. This fear makes you act impulsively, jumping into trades that aren't part of your plan, hoping that you can catch the trend before it runs away. But fear and FOMO make you sloppy. You start chasing trades instead of waiting for the right setups, and that's when things begin to fall apart. And then there's the emotional roller coaster that comes with trading. One moment, you're riding high after a win, feeling invincible. But the very next trade could take you down a peg. The emotional highs and lows of trading are exhausting. When you're winning, it feels like you've got the world figured out, and when you're losing, it feels like you're failing. This inconsistency breeds emotional instability, and when you're emotionally unstable, you're more likely to overtrade. You trade to recapture those emotional highs, and that desire to feel good again drives you to take trades that aren't based on logic, but on the need to feel in control. The need for control is one of the strongest psychological factors in overtrading. Trading gives you the illusion that you can control the outcome of a market. When you make a trade, you feel like you've taken control of your financial future, and that can be an addictive feeling. But the truth is, no one can control the market. The market is unpredictable, and overtrading is a misguided attempt to exert control over something you can't control. The more you trade, the more you lose sight of this reality. You begin to believe that if you just keep trading, you can fix your losses and force the market to behave the way you want it to. But that mindset is dangerous because it doesn't acknowledge the market's natural unpredictability. Here's the catch. The more you trade, the less control you have. Every time you enter a trade based on emotion rather than strategy, you're giving up control. You're allowing fear, greed, or impatience to take over your decision-making, and that's when your trading starts to unravel. And yet, overtrading feels like it's the right thing to do. Your brain tells you that action is necessary, that making more trades will lead to more opportunities, more wins. But in reality, that action is just masking your fears and your insecurities as a trader. There's another psychological aspect that many traders don't realize: the emotional cost of losses. When you take a loss, especially after a string of wins, it feels like a blow to your ego. Your brain doesn't like to feel like it's losing, and it reacts accordingly. This is where the danger of revenge trading comes in. After a loss, you feel the need to make it back, and fast. That's when the cycle of overtrading begins. You make impulsive decisions, take trades that don't fit your strategy, and try to recover what you lost, even if it means risking more than you should. But here's what most traders don't understand. Losses are part of the game. Every successful trader has experienced losses, and every trader will continue to experience losses. The difference between a successful trader and one who gets stuck in an emotional loop is the ability to accept losses as part of the process. A trader with the right mindset doesn't try to make up for a loss by rushing into the next trade. Instead, they take a step back, assess the situation, and wait for the right setup. They don't let a single loss derail them. It's the same way that athletes train. A professional athlete doesn't focus on every individual game or every single point. They focus on the long-term journey, the process of getting better, and the bigger picture. And that's what successful traders do too. They understand that trading isn't about any one trade. It's about consistency, patience, and managing risk over the long run. When you shift your focus from the need to win now to the need to execute your strategy consistently, your results will start to improve. This is where many traders get stuck. They don't separate their emotional state from their trading decisions. Every win or loss feels like a personal victory or defeat. And when you tie your emotions to every trade, you're setting yourself up for failure. You need to detach yourself emotionally from the outcome of each trade. The market doesn't care about your emotions, and neither should you. By doing this, you free yourself from the impulse to overtrade and start focusing on what really matters: your strategy and your long-term goals. To sum it up, overtrading is driven by emotions: greed, fear, the need for control, and the desire to recover losses. These emotions cloud your judgment and make you act impulsively, taking trades that don't align with your plan. The solution isn't to trade more, it's to trade smarter. It's to learn how to control your emotions and stick to your strategy, no matter what. In the next part, we'll explore the dangers of overtrading and how it affects not just your account balance, but your mindset and emotional well-being. When it comes to trading, most people think of the immediate financial impact. They see a trade go wrong, and the first thing they think is, "I lost money." And that's true, of course. But what many traders don't realize is that the damage goes far beyond just losing money. Overtrading does something even more insidious. It erodes your focus, your discipline, and ultimately your ability to trade well over the long term. First, let's talk about the costs. Every time you trade, you're not just risking your capital, you're also exposing yourself to various fees, slippage, and hidden costs. Let's break it down. Each time you open a position, you might be paying commissions or spreads, even if you don't realize it at first. This is money taken out of your potential profits. But that's just the tip of the iceberg. Slippage can occur when the price you expected to enter or exit at doesn't match the actual price due to market volatility. Slippage can eat into your profits, or worse, increase your losses, without you even knowing why it happened. The more trades you make, the more chances there are for slippage to occur. And if you're overtrading, you're essentially increasing the odds of these hidden costs eating into your profits. At first, it doesn't seem like much, maybe a few extra dollars lost on each trade. But over time, those small amounts add up. And the real cost is opportunity cost, the money you're losing by trading unnecessarily, instead of letting your capital grow slowly and steadily with the right opportunities. Now, let's talk about psychological exhaustion. When you overtrade, it's like running a marathon without taking any breaks. At first, it seems like you're making progress, but eventually, the exhaustion sets in. You start making poor decisions, you second-guess yourself, and your ability to focus suffers. After a while, your mental energy is drained, and your trading starts to deteriorate. This is where the burnout begins. Over time, you begin to question your abilities. After taking trade after trade and feeling like you're getting nowhere, the frustration mounts. You start second-guessing your strategies, wondering if you've missed something, or worse, if your edge is even real. This mental fatigue doesn't just make you feel bad, it compromises your judgment, and in trading, compromised judgment leads to bad decisions. It's a vicious cycle. The more you trade, the more mentally drained you become, and the more emotionally charged your decisions become. Overtrading isn't just physically exhausting, it's emotionally draining. Each time you enter a trade, you're putting your emotions on the line. A win might feel great, but a loss stings. And when you're overtrading, you're facing the emotional highs and lows more frequently. These emotional roller coasters only compound the stress, making it harder to stay disciplined and stick to your plan. But it gets worse. When you're mentally and emotionally exhausted, your decision-making ability plummets. You start to make rash, impulsive decisions, and that's when you start chasing trades that don't fit your strategy. Instead of waiting for the setups that align with your edge, you're jumping into trades based on a gut feeling or the pressure to do something, anything. You're no longer thinking clearly, you're simply reacting. The other danger of overtrading is that it forces you into a reactive mindset instead of a proactive one. When you overtrade, you're letting the market dictate your actions. You're chasing the market, constantly trying to catch up to movements and setups that aren't part of your plan. This type of trading is driven by fear. Fear of missing out, fear of losing your capital, fear of not taking advantage of every opportunity. But the truth is, trading isn't about reacting to the market. It's about anticipating the right setups and acting with precision when the time is right. Overtrading makes you reactive, and the problem with being reactive is that you're always 2 steps behind. The market becomes your master instead of your tool. And when the market is in control, your results suffer. Think about it. Every time you take a trade without a clear plan, you're throwing yourself into the unknown. Even if the market eventually moves in your favor, it doesn't matter because you've acted out of desperation, not strategy. Overtrading breeds this desperation, and that's when traders start making decisions that don't align with their strategy, like increasing their position size to make up for previous losses or jumping into random trades because they feel like they're due for a win. But here's the kicker. Even when you win in these circumstances, it's unsustainable. A win might give you a temporary boost of confidence, but when you're trading on emotions, those wins don't feel earned, they feel lucky. And lucky wins don't last. Eventually, the market will catch up with you. The losses will come. And when they do, they'll be even harder to deal with because you're already emotionally drained from overtrading. Overtrading is not just a financial issue, it's a psychological issue. And when your mental state deteriorates, your ability to make rational decisions follows. You start to second-guess yourself, doubt your strategy, and even lose trust in your own system. This erosion of confidence is one of the most damaging consequences of overtrading. It makes you question everything. You begin looking for reasons why your strategy isn't working, searching for flaws where none exist. And all of this stems from a lack of patience, the patience to wait for the right setup and trust that your strategy will pay off over time. But here's the reality. Trading is a long-term game. It's not about instant gratification, it's about taking your time, making decisions based on logic, not emotion, and sticking to your plan, no matter what. Tempting it is to jump in earlier or make one more trade. Now, let's look at the bigger picture. You might be thinking, but doesn't more trading mean more opportunities? In theory, yes, but in reality, the more trades you make, the more you expose yourself to risk and emotional turmoil. And the longer you stay in this cycle, the harder it becomes to break free. The key isn't to trade more, it's to trade better. To wait for the setups that align with your strategy, and when they do, act with precision and confidence. When it comes to trading, the most successful traders are often the ones who do the least. It sounds counterintuitive, doesn't it? But the truth is, the less you trade, the better your chances of making money. Successful traders don't rush into every move the market makes. They don't chase after every price swing. Instead, they practice the one skill that's often overlooked by many: patience. Patience in trading isn't about sitting idly by while the market moves. It's about waiting for the right opportunities, those that align with your strategy and give you the highest chance of success. It's about resisting the temptation to act on every market movement and instead waiting for the perfect setup. Now, I know what you're probably thinking, but if I'm not trading, I'm missing opportunities. That's the mindset most traders have when they start. They believe that every moment the market is open, there's an opportunity to make money. But in reality, opportunity only comes when the market presents it, and that's something you can't force. The key is to wait for the setups that fit your strategy, ones that give you a clear edge, not just a random chance. Let's look at an example. Imagine you're a professional poker player. In poker, you wouldn't play every hand dealt to you. Most hands are weak, and playing them would only drain your chips. Instead, you wait for the right hand, the one that gives you the best chance to win. You play the game by waiting for your edge to present itself, and trading is no different. The best traders are like poker players. They wait for the market to hand them the best opportunities, and when those opportunities arise, they don't hesitate. They execute with precision. But they don't force anything. They don't trade just because the market is moving. They trade when the market presents them with a high probability setup. And when they do, they make the most of it. Patience in trading is about knowing that not every price move is an opportunity. It's about being selective and choosing quality over quantity. When you trade too often, you dilute your edge. You end up taking setups that don't align with your plan, hoping for a win that's just not there. But when you wait for the right setup, you give yourself the best chance of success. This doesn't mean that waiting is easy. It's not. In fact, it can be incredibly hard to sit on your hands when you see the market moving. The market always seems to be in motion, always pulling you in, making you feel like you need to act. But here's the key. You don't need to act all the time. In fact, the more you wait, the more you preserve your capital and energy. And when you finally make a trade, you're doing it from a place of confidence, not desperation. But here's the reality. Trading less leads to better trading. When you trade less, you have more time to analyze the market, to reflect on your strategies, and to develop a deeper understanding of the conditions that lead to success. Every trade is a data point. Every trade you make teaches you something about the market, your strategy, and even yourself as a trader. When you overtrade, you flood yourself with data that you don't have the time or mental energy to process properly. The result? You end up trading on impulse instead of strategy. Let's put this into perspective. Imagine you're trying to build a skyscraper. You wouldn't start laying bricks everywhere, hoping that the structure will come together. No, you'd carefully plan, measure, and only place the bricks when you know exactly where they should go. You'd wait for the perfect moment to add the next piece, so the building can rise in the right way. That's how you should approach trading. Every trade is a brick in your portfolio, and you need to wait for the right time to place it. If you start adding trades randomly, the whole structure falls apart. In fact, the more you trade, the more likely you are to run into mistakes. Trading mistakes are inevitable, but overtrading increases the frequency of those mistakes. When you make multiple trades in a day, you're bound to act impulsively. Maybe you're feeling a little too confident after a win, or maybe you're trying to make up for a loss. But each time you force a trade, the chances of making a mistake go up. And every mistake costs you, emotionally, mentally, and financially. But what happens when you start practicing patience? What happens when you take a step back, analyze the market carefully, and wait for the perfect setup? You start to make fewer mistakes. You stop chasing the market, and instead, you allow the market to come to you. When you finally place a trade, it's because you've waited for the right moment and you've taken the time to properly analyze the situation. You're no longer trading from a place of emotional desperation, you're trading from a place of calculated decision-making and confidence. One of the most powerful concepts in trading is that of trade execution. Great traders don't just focus on getting in and out of the market, they focus on executing their plan with precision. The more trades you make, the more you risk executing badly. The more impulsive your trades, the worse your execution becomes. But when you wait for the right setups, your execution improves because you're calm, focused, and aligned with your strategy. In fact, when you trade less, you actually learn faster. You're not distracted by constant trades that take up your attention. You can focus on refining your strategy, understanding the market's patterns, and improving your emotional control. Every trade you make adds to your experience and your ability to spot the right opportunities. The more you wait, the better prepared you are for when the right trade presents itself. Let's take a real-life example of how patience pays off. Consider a trader who waits for the market to align perfectly with their strategy. They don't rush in when the market is volatile or uncertain. Instead, they wait for a clean breakout or a strong trend to develop, and only then do they make their move. This trader might only trade 5 to 10 times per month, but every trade is executed with confidence, precision, and patience. Over time, this trader grows their account steadily, without the emotional roller coaster of overtrading. Compare this to a trader who makes 50 trades a month, chasing after every small move in the market. Sure, they might win a few trades here and there, but their account is filled with impulsive trades, unnecessary risks, and mistakes. Even if they do win, the profits are minimal compared to the energy and emotional toll of overtrading. In the end, this trader's account struggles to grow, and their emotional state deteriorates. Now that we've covered the psychology behind overtrading, the emotional and financial dangers, and the power of patience, it's time to tie everything together. The bottom line is this: trading more doesn't lead to success. It leads to burnout, frustration, and unnecessary losses. The traders who succeed are the ones who understand the value of patience, consistency, and emotional control. They don't chase every move in the market. Instead, they wait for the right setups, execute with precision, and stay disciplined, even when the temptation to overtrade is strong. It's easy to get caught up in the idea that more trades equal more opportunities. After all, the more trades you make, the higher your chances of winning, right? But in reality, overtrading only leads to one thing: mistakes. The more you trade, the more you expose yourself to the risks of emotional trading, poor execution, and the inevitable psychological burnout. And the more you trade out of emotion, the further you drift from your edge, the strategy that gives you an advantage over the market. The truth is, patience isn't just a strategy, it's a mindset. It's about accepting that trading is a long-term game, not a get-rich-quick scheme. You have to be willing to wait for the right opportunities, even if it means trading less often. But when those opportunities do arise, you need to be ready. And when you trade with patience and discipline, you'll find that your results improve, your emotional state remains stable, and your confidence grows. So, here's the challenge I want to give you. The next time you feel the urge to trade, ask yourself, am I trading because it's part of my strategy, or am I trading because I feel the need to do something, anything? If it's the latter, then don't trade. Wait for the right setup. Trust the process. And remember that the best traders aren't the ones who trade the most, they're the ones who trade the best. Overtrading might feel like the right thing to do in the moment, but the reality is that it's a surefire way to lose money and destroy your mental game. Every time you overtrade, you're sacrificing your edge, your discipline, and your long-term success. Instead, focus on quality over quantity. Wait for the perfect setups, and when they come, execute with precision and confidence. The market will still be there tomorrow and the day after that. But every bad trade you make takes you one step further from your goals. If you want to take your trading to the next level, it's time to make patience your default mindset. Start by tracking your trades. How often are you trading? Are those trades part of your plan, or are you simply reacting to market movements? Analyze your trading behavior. If you find that you're overtrading, take a step back. Remember, it's okay to sit out and wait for the right opportunity. The less you trade, the more you'll start to see the market for what it truly is, an arena for disciplined traders who can execute their strategy with patience and emotional control. So, I want to hear from you. What's the biggest change you've had to make in your trading mindset, and how did it impact your results? Drop your answer in the comments below. I read every single one, and I'd love to know how you've applied these concepts to your own trading. And if you found this video helpful, don't forget to subscribe to the channel so you don't miss out on more powerful insights that will help you become a more disciplined, patient, and successful trader. The journey to consistent trading success isn't about making more trades, it's about making better trades. So take a moment, reflect on your trading habits, and remember, patience isn't just a virtue in trading, it's the key to long-term success.